An entity, really, in a legal sense, is any legal form that is, created and governed by state law. So state statutes will govern it, which can include trusts, LLCs, corporations, partnerships.
The majority of people trade time for money in the hopes of building wealth. I'm here to tell you that the traditional methods don't cut it anymore. Welcome to the Passive Income Power Podcast. My name is Doug Earthman. My partner Mickey Bernstein and I are going to dive deep into the power that passive income can have on your quality of life. We're going to discuss alternative assets, strategies, and insights through interviews with the very people who have found freedom through their power. I hope you enjoyed this episode of the Passive Income Power Podcast. All right, thanks for tuning in to the Passive Income Power Podcast. My name is Doug Earthman.
And I'm Mickey Bernstein.
And we are your hosts. We're honored to have Jake Kasser with us today from Glankler Brown, which is a prestigious law firm in Memphis, Tennessee that we have utilized for quite a bit of legal work over the past couple of years. We're excited about this week's episode and the takeaways you're going to get from Jake's wisdom in business and securities law. Both myself and my partner Mickey have known Jake for many years. He's a close friend of my wife's family, and we run around in some of the same social circles. Jake graduated from the University of Memphis with a bachelor's in accounting. He then went to get his master's in accounting and followed that with a law degree, all from the University of Memphis. Paid quite a few people's salaries through his tuition. He's one of their most prized alumni. Anyways, he's a partner at Glankler Brown Law Firm. He's been practicing for 10 years in corporate and business transactions, tax, lending, and estate planning. He's helped our company form quite a few legal entities and done some other work for us as well. Some of you may or may not know you can invest in projects as an individual or through an entity, and Jake's going to help explain some of that to us. When to invest in an entity, what types of entities, and when it makes sense to utilize them. And we'll let Jake start off by introducing himself a little bit and giving us any background that I missed.
Sure. You covered it pretty well. My name is Jake Kasser, as Doug said. I've been practicing law since began in August 2013, so almost 10 years here. Before that, I got my CPA license and did accounting for a little while. Then went back to law school and got my law license, obviously. So I have a background in, tax and accounting and law, and primarily work on transactional stuff, which can mean a lot of different things. While we are, I would say, a prestigious law firm, like Doug said, we're small. We're relatively small. We're local to Memphis, so you typically will practice in multiple areas. But primarily, I work in transactional with, concentrated in business formation, organization, governance stuff, and private equity is part of that, M&A stuff. And then the other part of my practice is estate planning and probate stuff. And the estate planning we work with a lot of smaller, closely held companies. So you'll typically do estate planning as part of that too. Need to get Doug to do his in here, and Mickey's already got his done. So that's what I've been doing.
I definitely need to take advantage of that service you provide.
And it costs a little bit of money, right, Doug?
Yeah.
And I got to throw in a couple of personal things. And I actually know Jake because I knew his wife first. Jenna, and she is gorgeous. And they got these gorgeous kids, and there's two of them. She's got an identical twin, so I got to be pretty good friends with them, and then met Jake, and Jake and I used to lift weights together. I can still visualize us standing there doing it. Of course, he was lifting quite a bit more weight than me. But good memories.
When do we ever do any leg work out together or anything? I don't think we did we? Are you still at the?
I think
I don't know if I remember those. You still at the GAC?
Doing some deadlifts together.
I can
315.
I can still have a memory of us doing bench press and doing
Mickey, you're a pickleball player, aren't
triceps.
you? Mickey, you're a pickleball player, aren't you? Are you doing pickleball?
No,
You're not.
no, I'll fall over.
Everyone's doing pickleball now. Doug, you play pickleball?
My wife's a
I've
great
never
pickleball
played.
player.
I haven't either, but like Lifetime put in this whole pickleball court in the gym. They got rid of a basketball court and put pickleball in there because it's like the most popular sport in the world now.
I was just over in Dubai, and pickleball, they call it paddleball there. And when I called it pickleball, they were all like, looked at me like I was crazy. And they're like, paddleball? I was like, yeah, that's it. But it's on every corner in Dubai. And I thought that was a very American thing, and it is way more popular in Dubai than it is here.
I saw something where the ratings on like a pickleball whatever on ESPN or something, they have those pickleball like tournaments on there that it beat out some other like tennis and golf and other stuff in ratings. So it's you can go pro doing that now.
Yeah.
So I'm going to jump into this stuff.
Let's I think we start out by going over what is an entity.
Yeah.
What are the different types of entities?
So that's a relatively broad question. I mean, an entity really in a legal sense is any legal form that is created and governed by state law. So state statutes will govern it, which can include trusts, LLCs, corporations, partnerships, different types of partnerships. Every state is going to have LLC statutes and corporate statutes and partnership statutes, as well as some type of trust law too. I know Doug had said he had some interest in kind of trusts, and those are a little bit foreign to people. Mickey may have some idea of trust that he's dealt with some trust, but trusts are, there are different reasons to have trust. The most common, I would say, is estate planning, and you have a revocable trust, which technically doesn't provide you any real limited liability protection. It's just it's a structure that allows you to avoid probate by titling your assets in the name of a trust. There are other trusts, like there are irrevocable trusts. There are which can be different types of trust. Tennessee, for example, has what's commonly called an asset protection trust that is specifically, to protect assets that are placed in the trust from creditors. Other states have an asset protection trust statute as well, like Nevada, Delaware, I think Alaska has one. But again, those are technically those can provide liability protection to the beneficiary and the trustees, but those aren't specifically provided by statute, like with LLCs and corporations, where state law says these entities provide liability protection to the members and owners of those entities. Which liability protection, that's probably not a common concept people understand either. It provides liability protection personally. So, it doesn't mean the assets of that entity are protected from claims of creditors or from lawsuits and judgments. It means the owners aren't liable for those debts by virtue of their ownership or interest in the company. Obviously, if people have ever, gotten loans through an LLC financed acquisition of property or something, then you likely had to sign a personal guarantee as part of that. So you're not protected if you're personally guaranteeing debt, but in general, you don't have any liability for the LLCs or corporations' debts. So the most common thing you would hear is if the LLC is sued and has a big judgment against it, the owners, are not liable to satisfy that judgment. There are certain exceptions to that. I don't think you necessarily need to get into right now, but where you can bypass that liability protection, it's called piercing the corporate veil typically. That's not something that's easy to do, and it depends on different states and whether what the requirements are to establish that. But
Are those the is it called bad boy carve out or
no,
something
that's in
along those lines?
that's for that's in loan transactions and things like that, where you'll have these certain carve outs that you will be liable for if you commit. So it's not a personal guarantee by itself, but it is if you're committing certain bad boy acts that you can be liable for those. But it's a different thing. Piercing the corporate veil is there are certain ways you do it, and I don't do litigation, so I'm not up to date on all the requirements of that. But in general, it would be you're not following corporate formalities of the LLC or the corporation, in that you're titling assets of the LLC in your own name. You're commingling funds of the LLC with your own personal funds. Things like that will tend to show that you're not using the LLC and not following corporate formalities, so you should be liable for its debts too, personally. So it's a legal theory that I don't know how often it is successful, but it's not common that it would be successful, especially if you're operating normally as you should. So, and I know we've kind of talked about when you would need to have an LLC or an entity, and that's if we're talking strictly in like the investment context. You're an investor and you're investing in another entity that is a limited liability entity. It's not necessary for you to have your own separate LLC or whatever to protect yourself, because you're investing in an entity that provides liability protection. The reasons to invest through your own entity, and I think Doug and I discussed it the other day. I mean, one is to consolidate your investments. If you have multiple investments in multiple different projects, you can consolidate those into one holding company, which could be done through a trust, but most typically would be through some type of LLC. And another thing could be to have some anonymity through your investments. Now, you can't have anonymity necessarily from the the investment vehicle you're investing in. I mean, they're going to probably require you to disclose certain things, but from a state standpoint, you don't necessarily have to disclose. Like in Tennessee, you don't disclose who all the members are of your entity. You don't have to disclose that in your state filings or anything like that. So, I've had people who have wanted to use LLCs or trusts to buy real property so that their name is not associated. Now, you can find it. I mean, in Tennessee, if you dig into, or at least in Shelby County, if you dig into the registrar's office filings, you're going to eventually get to who is involved with that entity. But in general, you can't just search and find that person. And so I've had people from an anonymity standpoint want to use entities solely for even buying their principal residence. They do that because Tennessee, you can find, Shelby County again has a searchable online to the assessor's website where you can find who owns what property and where they live and all that stuff. So it can make sense there too. But I don't know if
Jake, you touched on for an LLC. You touched on liability and anonymity. Are there other benefits for investing in it through an LLC?
I mean, not necessarily. I mean, it's still, other than liability protection and I mean, if you're going to have multiple people investing with you, I think you need to have an entity form. I don't think you want to do that separately, and you have to consolidate your funds and all that stuff. But other than that, it's not like that entity is going to provide you some other real benefits that you couldn't get by doing, it personally. It's probably easier to do it individually if, strictly talking about investing. So you're not, by that I mean, you're not operating an operating business. You're investing in some other entity and they're in charge. Either if it's a LP, you have a general partner, or if it's an LLC, you may have a manager or a managing member or something that is operating that entity. So, you yourself as just a passive investor individually are not exposing yourself to some type of personal liability by doing that. And it's, if we're talking about a single investment, it's not any real different than if you invested in through your own single member LLC. And from a tax standpoint, a single member LLC is going to be most likely going to be taxed as a disregarded entity. And what that means is, from a federal tax standpoint, the entity is disregarded as separate from its owner. So it's as if the LLC structure doesn't exist from a federal tax standpoint. From a state law standpoint, it does exist. I mean, it's a state law entity that provides liability protection. But if you've ever, used a single member LLC for federal tax purposes, you just report the income and expenses from that LLC on your own personal income tax return, your own 1040. You don't have a separate return. You prepare for that. So it's almost the same thing, really, if you're investing personally or through a single member LLC. Again, talking about one investment or two investments or something like that. And a lot of people probably don't necessarily need entities to do that through. If they are relatively small investors making, investments in different entities.
You had brought up investing as a group, and that having an entity such as an LLC to invest together with other people. Let's dive a little deeper into that, because I have personal experience there as well.
And I mean, part of that is obviously if you're pooling funds, you need to do that. I mean, you have to pull it through one entity, and that'll be the investor. But even if you don't necessarily need to pool your funds, if you guys are kind of doing this as a group, I think it's certainly important to do that as, and if you have different things where maybe you have a couple guys who don't really want to be involved, they're really super passive, and one or two who are going to be more involved and dictate investments and do those things, you definitely want to do that through some type of entity, one for your own liability protection for everybody, and two, to using an LLC to designate who's going to be managing. We do those through your operating agreement, you designate who's going to be operating that entity and who doesn't have any obligations to do anything with that entity. And I think that's and Doug, that's what we've done with Doug for the most part, or at least initially. And Doug would take over the reins of that entity in managing it. And, obviously, Doug is invested in those entities too, so has some skin in the game, which is, helpful for, I'm sure, the other investors, that he's going to operate it to the best, to make everyone return the best it can be. But it's certainly, and depending on like the number of people and the amount of money we're talking about, it just makes sense to do that through an entity. And I'd say the most common entities I work on are certainly LLCs. We don't do a lot of corporation work. That's certainly become more common, certainly for private entities, obviously. And the LLCs are just, from a formality standpoint, they're much less formal. Like you don't have this. You don't have to necessarily. You don't have to issue stock certificates with a corporation either, but most people do, and sometimes that's familiar to people and they like that. But things are just a lot more. I wouldn't say difficult, but they're a lot more involved with corporations. I mean, one example would be if you, for a corporation, if you want to issue different classes of stock, that stuff needs to be set forth in your charter that you file with the state. You got to state what different classes of stock you offer. With an LLC, technically do all that through your operating agreement. So you're not filing anything with the state or have to update your documents with the state to issue different classes or series of membership interests or things like that. They're just simpler and they're more commonly used now, certainly. That's great.
Yeah. So for everyone, an entity with a couple other friends is how I got started. Initially coming up with the minimum investment amount for a private real estate offering is, it's hard to start out and throw down that amount of capital. And if you do it, you may be limited in how much you can participate in or how often. So I got together with some friends and we created an entity, and we used that entity to meet the minimum requirements for an investment. And that is a fantastic way to get started in real estate investing if you're limited on the amount of capital that you can come up with, or you can come up with a certain amount of, certain times of the year. And I'd say from that standpoint, making sure that whoever, if you were to do that you teamed with, has similar abilities and goals, and that you're aligned once you get an entity formed. If you plan on using it to invest multiple times, but it's a fantastic way to get started.
And and to spell out thing. I mean, obviously you can have a contract between people, but forming an entity, specifically an LLC, and getting your operating agreement in place sets forth, what everyone can and can't do with respect to the entity, and that can come in handy when you have disagreements, as you guys well know from your recent, experience with a former partner. So, it's helpful in that sense to spell those things out. And typically with an LLC, I mean, as a member, you don't have any right to withdraw from the LLC and get your money back. Now, you may have a preference, a preferred return, which gives you your capital back and some interest percentage first, but that provision doesn't mean you're guaranteed to get your money back. So it's it's established that on the front end where you're not, if someone puts in 10, 20, 30,000 and a year later, like, well, I want my money back right now, you have a document saying they're not entitled to that, and they can get it back if they liquidate or we actually make distributions, but you control that for the most part. And that's, we wanted to talk about, or I think something important to talk about is specifically with LLCs are the governance structure for those. And it may be spelled out in state statutes or it may not, but typically you can have what's called a member managed LLC, a manager managed LLC, or a board or director managed LLC. The member managed LLC is probably, I'd say, the most common, and that just means from a state standpoint, if you form a member managed LLC, if you set that out in your articles of organization, which in Tennessee you have to do that. Some states you don't necessarily put that in there, but that just means on the face of it, the LLC is managed by its members who each have a right to manage the LLC, make decisions, those types of things, and you can't typically make any real major decisions without at least majority approval of those members. In contrast, a manager managed LLC is governed by one or more managers who may or may not be members. And so you vest all, not all, but most governance rights are vested in a manager who controls the LLC, who makes decisions for the LLC, which is really helpful if you have a number of members, 4 or 5 or more, and if you are engaging in certain transactions like acquiring real estate or doing things, you have one person for the most part who is signing on behalf of the LLC and entering into contracts and those things. It really eases things from an operational standpoint, or it can ease things. And a board managed or director managed is essentially equivalent to what you'd have for a corporation. You have a board of individuals. You may have officers too. The board makes all decisions. That's a little more complex and a little more formal, like a corporation. You have to have board minutes and they approve, and then you have to have a members approve things like that. That's probably more commonly used in larger entities, or just if they're used to using the corporate formalities, they may use that. I don't typically use board entities. My most common is probably manager managed entities as well as member managed, but that all depends on what you're doing. Like in Doug's case, I think we did manager managed type entities to, it doesn't mean that.
We've done both.
Yeah.
I know in my former career as a dentist, I started out as a proprietorship when it was just me, and then we had a partnership, and then we had a C corporation, which of course is a lot of legalities and expense, but got a lot of many benefits from it as well, including a huge, robust retirement plan. Then as I started winding things down, went to an LLC. So just in that one business over 40 years, had all those different entities. Let me ask you this, Jake. I see a lot of LLCs being formed in 4 states, Delaware, Nevada, Wyoming.
Yeah.
Does it matter where, and what are the benefits of when I see those
So, I
things?
mean, well, the answer is it depends. I mean, I'd say Delaware is certainly the most common state in which entities are formed, whether LLCs or corporations. Primary reason for that is Delaware has, well, primary reason in theory is that Delaware has developed case law. They're business friendly. It's a business friendly state. So you have predictable outcomes if you have disputes and different things like that. But I think a lot of people form in Delaware at this point because that's what they've heard to do. It's like, well, you form in Delaware, go do it in Delaware. It's like, well, there's no reason for you to do that, um, especially if you are going to be operating a business and you're in a different state. So if you, for example, if you purchase real property in Tennessee, and I'm not saying you're investing in a separate entity, you're purchasing the property through your own entity, and you're going to be operating a business through that. Even if you formed in Delaware, you're going to have to register in Tennessee to do business here. So you're not really bypassing anything from a state standpoint. You're still going to have all the same requirements you would if you just formed your entity in Tennessee. You're going to have additional requirements. You're going to have to keep your entity active in Delaware and keep it active in Tennessee. Um, if you are, and I think Doug and I've talked about this in the past, if you are forming an entity that's going to be investing in other entities as a passive investor, and that it may be in multiple entities in different areas, and you may have different people from different areas, different states, then I've typically recommended a Delaware entity. There's no tax in Delaware. If you're not operating a business there, you have an annual fee you pay. Um, so I've typically recommended that in Delaware there because you're not necessarily going to have to register in other states. I know Doug has had an issue though with potential. How did that? Didn't you have like a multi-state tax issue come up? Which I'm still not sure is really that relevant, but
Yeah, we had a portfolio investment that was across three different states. So we had three different, I guess, state K1s coming into that entity, and I
so that's going to be a problem
not
wherever
very.
you are. I think really what should be happening in that case is the entity you're investing in should pay. I mean, there's a way you can. Multi-state taxation is a very complicated area, but there's a way that entity can pay any tax on your behalf, and you're not paying any. You're not having any separate filing requirement and all those different things. But that's not going to matter. Whether you form in Tennessee or Nevada or Wyoming or Delaware, you're going to have that problem. As far as like Nevada and Wyoming, I think essentially the benefits are the same as Delaware. I mean, they're business friendly states. There's no tax, I don't believe, on corporate entities there. If you're formed there, not operating there, and there may not be if you're operating there either. But they don't have a long history like Delaware does with different case law interpreting different statutes and things like that. So it's not the most common, I don't think at this point, even though I have seen random things where entities are formed in Wyoming for no real reason I can tell other than they kind of heard that you should form in Wyoming. Tennessee, Tennessee's a little bit unique in that we don't have a state income tax, but do impose a tax on LLCs at the LLC level, as well as partnerships. So if you're not actually operating in Tennessee and there's no need to register in Tennessee, that would be the times, I would say, just form it in Delaware. And if you ever need to register in a state, then you can do that. But it's not. I don't think there's any reason to, like we were talking about before, if you are operating a business in Tennessee, to form in Delaware and then register in Tennessee. There's no real reason in how not you would do that.
Yeah, and I think that's how that is how we are set up, is Tennessee LLC for our company, but for funds that we're using as investment vehicles, we're in Delaware. Is how I think we're set up.
And I think it makes sense in y'all's case, even though you have the multi-state, I guess, potential multi-state tax issue. That's not dependent on where you're formed in Delaware or Tennessee. That's dependent on how those other states.
I'm glad you think that makes sense, because I'm pretty sure that you did all of
That
it.
I recommended it. That makes sense.
So you passed the test.
Yeah. Well, but I do think there's so much information out there now that, if you're just Googling where should I form an entity, you're going to see Delaware come up most likely, and probably Nevada and Wyoming too. And I think that just, not that it's bad. I mean, it's not, you're not going to, other than you may have some additional fees you have to pay each year or something like that. I think that's why it happens a lot. I mean, I don't think, a relatively inexperienced individual who forms his entity in Delaware is doing it because of the established case law they have there for businesses. And I don't think that's happening. I think it just is a very common thing for people to do it now. And even attorneys get stuck in that too, I think. They're like, well, we form in Delaware. Why not?
And some of the fees you're talking about, that's the registered agent, right? That you have to.
That's a good point. That's an additional fee you would have to pay. So I would assume most states, but specifically Delaware, it has an annual fee you pay. It's called a franchise tax, but it's really an annual fee of like $300 you pay each year. Tennessee has the same thing. It's an annual report you file, and you pay a fee, $300 with that too. The difference would be what Doug was just referring to is every entity that's formed in a state has to name a registered agent, which is an individual or organization that is designated to receive service of process if that entity is sued. So if someone wants to sue your entity, they look up on the Secretary of State's website who the registered agent is, and they send a subpoena, or they send some type of complaint to that registered agent, who, by sending it to them, you've effectively served that entity. And the registered agent is required to have an office address in the state. So if you don't live there, you'll typically name, so for Delaware, for example, you'll name a registered agent service that serves as your registered agent. That's all they're doing. They'll
it's basically your sort of home base address.
Yeah. I mean, in Delaware,
for that state, and that's an annual fee that you're paying to reserve that as your registration address.
Right, and those fees differ somewhat widely. I mean, the cheapest one is probably around $100, but you can pay $400 or $500. So it does add some additional fees to do that, but it's not.
So talking about fees, so if you're paying $300 a year to keep your LLC open, and then another $100 for your registered agent if you have a out-of-state entity, there's sort of a tipping point and when it makes sense to have a entity to invest through or not. If you're just doing a one-time investment, that those fees start really eating into your profit. Yeah. If you're, looking at like, oh wow, after a few years, I've spent $1,000 of my $25,000 investment. Right. That's may not be worth the trouble.
Certainly. I mean, the additional fees, and there is some compliance part of that too, where in Delaware, you pay your franchise tax. In Tennessee, you file an annual report. But if you don't do those things, your entity will be technically dissolved. It'll be administratively dissolved, and which may not matter, depending on what you're doing, but it can matter if you want to, like sell your interest in that entity that you formed, and if you haven't filed annual reports in Tennessee and it's dissolved, the buyer is going to say, well, you need to get your entity active, which can require you to spend a bunch of money and time filing past due annual reports and getting it active, filing any tax returns you have to file. So it can be, in addition to those fees, can result in additional burdensome stuff. I mean, I have an estate I'm involved in right now with a guy who had a single member LLC, which he needed because he owns a bunch of properties, but he didn't keep it active, and he passed away, and his the executor administering his estate, we don't have a bunch of information we need to prepare and file tax returns. So we're at a point where we're trying to sell property owned by the LLC to pay debts and things for the estate, but we can't get active in Tennessee because we have to file back due franchise and excise tax returns, which require us to have information to prepare those and file those. And he should have had one, but those complexities can arise if there's not a need for you to do it. I mean, I don't just recommend if someone comes in and they're like, I'm going to form an LLC, I won't typically tell them that they have to do that. I mean, it doesn't make sense all the time to do it, and doesn't change anything like we were talking about earlier. It's not necessarily more beneficial to have that, as opposed to just doing everything in your individual name, and that can make things simpler and easier for just a normal state.
And I'll also point out that on the dental practice LLC, when it was time to shut it down, there was some hoops to jump through to shut it down, which for someone like me was a little confusing. But we got it done. Wasn't that hard, really? But
yeah, I mean, it
took a little thinking and understanding.
Yeah, going through the formalities of dissolving your entity, and it can be. It doesn't have to be difficult, but it does require you to do, a few steps. And with a corporation, it's more difficult. Maybe not difficult, but it requires more steps and is more formal. And with corporations too, speaking of like dissolution and liquidation, it's harder from a tax standpoint to get stuff out of your corporation. There's usually tax consequences, if you're distributing property or assets from the corporation to a shareholder in liquidation, for example. There's usually tax consequences involved with that. As opposed to an LLC, you can typically get assets out of an LLC without any real tax consequences on that transaction. Now, if you later sell property that you've taken out of an LLC, you'll have potential taxable gain and stuff involved with that. But that's another reason why certainly LLCs in my case are more common, or I've more commonly recommended those as opposed to corporations.
Okay, well, we covered different types of entities and different, that have them in your state or a different state, the benefits and the cost and a few negatives. But if someone is looking to, and I think the majority of people watching this are individual investors.
Right.
So at what point should they consider investing through an LLC?
What's really going to, again, depend on their circumstances. I mean, if you're a single, I mean, if you're a one person investing, at the point where you're maybe have 3 or 4 separate investments, I think you want to consider for just your own, simplicity and organization to consolidate those into some type of entity. And we did, you can do that through a trust, because you're not necessarily doing that for your own liability protection. So you can set up a revocable trust or something like that, and own those interests in that revocable trust, which would make sense for people to do too, and probably makes more sense for a lot of people if it's just you to use a trust to do that. If you're going to have multiple people involved at some point, I would do that through an entity. But I think strictly from the consolidation standpoint, a trust probably makes a lot of sense for a lot of people. And for instance, in Tennessee, if you do that through a trust, you don't have some separate franchise and excise tax. That's not subject. Trusts aren't subject to that in Tennessee, except for what are called business trusts, but no one has those. Normal trusts aren't subject to tax. So I think, it makes sense to at least talk to an attorney at some point if you have 3, 4, 5 investments, and figure out what the best thing is for you, as opposed to holding those individually. Is operationally and even like we talked about from an estate planning standpoint, what the best thing is to do at that point.
So I know this is a tough question to ask or to answer, just because everyone's circumstances are different, every situation's different. But in terms of, can you give us a range on cost to open an LLC or to a trust?
Sure.
Just so people will have like a ballpark. Is it $200? Is it $2,000? Like, and in between.
So the LLC, if we're talking about a single member LLC, there are filing fees with that. So if we include that in there, I mean, it's in Tennessee, it's $300 to form the LLC. If I were assisting in doing that, you're probably looking at maybe $1,200 in legal fees or something like that, plus whatever filing fees are incurred. And as part of that, we'll typically assist in getting an EIN and certainly have an operating agreement, even though we won't necessarily use it that much as a single member LLC. We'll have one in place for formality, and we'll assist with other organizational documents like resolutions and things for the LLC. With a trust, it'll sort of depend. I mean, drafting a basic trust agreement, there aren't any filing fees associated with that, but drafting a basic trust agreement, is probably ends up being around $1,500 or something. It sort of depends on what, if that trust is going to be your primary estate planning vehicle, it's going to set out how you want everything done, and you're going to include more assets in there as opposed to just your LLC interest or investment entity interest. Then it's going to be a little more involved, and probably gets around $2,500 because technically with a trust, revocable trust for estate planning purposes, you need to have all your assets titled in that trust to be able to avoid probate. So that's going to include things like real property. And bank accounts and different things like that. And that brings up another point. If you are investing in, or not even investing, if you own multiple properties in multiple states, even though, maybe they're not investment properties, if they're vacation properties or something like that, that would be another reason to establish an entity or a trust to deal with those properties. Because if you're a Tennessee resident and you own a home here, but you also own a property in Florida, you need to, if they're owned individually in your individual names, you're going to have to technically go through a probate process in Florida. So you'd have to open a probate here, and then you have to open a probate in Florida to get that real property transferred. So a way to avoid that would be to put those entities in a Tennessee entity or a Tennessee trust, to avoid having that ancillary probate deal in Florida. So that'd be another reason. Even if we're not even talking about investments, that would be a reason to do that.
Good deal.
Okay, well, Jake, can you tell our audience how they can reach you if they'd like to utilize your services?
You get a bunch of calls, I bet. Yeah, I mean, you can, my direct line is 901-576-1896. My email is jkasser@glankler.com, and you can find everything at our website too at, www.glankler.com. And call me directly. I'm happy to, even if you just have questions, I'm happy to talk to people, as long as it's not like, a 3-hour thing or something we're going through, and I'm not preparing stuff for you. I'm happy to talk through people, and I'm not going to recommend something for you. I know attorneys don't always get the best rap around their fees and what they do, and people tend to think all we do is try to bill you for stuff we're not necessarily needing to do. That I really don't think that's how I operate at all. I mean, if I don't think you need something, and I'm not just going to do something for you that is unnecessary just to charge you for it. I'll tell you, if you really want to do it, we'll do it, obviously, but I don't think you have to do that right now. So I like to think I'm a little better than the name attorneys get from people at this point.
Well, we love working with you. Jake Kasser at Gankler Brown, in the heart of East Memphis. And we thank you, Jake, for sharing your knowledge. It's been a fun, informative episode of the Passive Income Power Podcast. Folks, help us help you find your passive income superpower. See you next time.
Thank you for watching the Passive Income Power Podcast. We hope you gained wealth building insights. I will ask you to do 3 things to help us serve you best. Go to our website at 2dinvestments.com, click on Investors Club, and fill out the basic information to have timely access to new offerings. 2, follow us on Facebook, Instagram, and LinkedIn. And 3, feel free to set up a call with Doug or Mickey through our website. We would love to help you find your personal superpower.